Hi, this is Michael Fisher for SavingAndInvesting.com, and in this video we're going to look a little bit more at income statements. In particular, we're going to look at an income statement example and illustrate a number of features of the income statement, and we're going to look at some of the things that happen on the income statement and how it's structured. Now, the first thing is that the income statement is also sometimes referred to as the profit and loss statement or the earnings statement, or any other number of names. And what the income statement does is it captures how a company makes money over a period of time. So for example, the income statement could be prepared for a financial year. So for example, in this example, we're preparing it for the year ending December 31st, 2010. That's what's presented on the spreadsheet. And it could be for a company, there could be an income statement for a quarter to look at how the company made money in a particular quarter of the year, or it could be for a fiscal year. And the income statement is one of the three main financial statements, along with the balance sheet and the statement of cash flows, or the cash flow statement. Now, the income statement is of interest to a number of people. It would be of interest, of course, to investors who would like to see how a company makes money. It would be of interest to the management of the company to see where costs over different years have increased or decreased, or where there may be changes, or even to do competitive analysis versus other companies in the sector. And on that basis, the income statement can be very useful to a number of interested parties. It would also be looked at, obviously, in the equity investors, any investors in bonds, and so forth. Now, the income statement, as we can see it here, starts with the revenues, and the revenues are basically the cash inflows, or the amount made by the company that comes into the company based on the products sold or the services provided from the company's operations. And it's the first line of the income statement typically. And what the income statement then does is it takes revenues, subtracts a number of expenses or costs down the income statement to arrive at the bottom line, which is the net income or the profit. And the way this is typically structured on the income statement, although it can vary, but typically the revenues, what the company has sold, products, services, etc., we'll subtract, first of all, those costs that are most linked to the operation or the sales of the products, down to, at the end, the expenses that are less linked to the operations and the actual sales of products. So for example, we're starting with an operating section effectively up here, where we have the cost of goods sold, or the cost of sales, and then operating expenses. And then we have a number of non-operating expenses. For example, the interest expense, which is obviously very dependent on how much debt the company has, and the income tax expense, which is obviously dependent on what the income tax rate is for a company in that given country or state, or the regime within which the company operates. The cost of, let's start at the top then. So the revenues, as we've said, are the cash inflows that the company has based on products and services sold from during that particular period. So let's say the company sells 1 million products, each for $100, then the revenues would be $100 million, as is the case in this stylized income statement. And from that we subtract what's known as the cost of goods sold, which are those costs that are directly attributable to those products or services that are provided. And the cost of the goods sold, therefore, would be, in the case of a manufacturing company, for example, the material costs, also what's known as direct labor, and overhead costs. But basically those costs that can be attributed directly to the units in question. So if a company sells, as we said, 1 million units, 1 million tires, each for $100, then the cost directly attributed to those tires in this example would be $60 per tire. In other words, $60 million overall for the total company. And that would be the cost of goods sold. From that we can calculate a gross profit, and we'll come back to some of these profits in a further video and discuss some of the margin analysis that we can do. Then next in the income statement we look at operating expenses, general selling and general selling, general, and administrative expenses, depreciation, and amortization. We subtract those, and we get to an operating profit. And so this covers the entire operating section. So basically, we've taken the revenues, we've subtracted all of the operating costs, those directly attributable to the product, those that are more general to the company, but nonetheless operating expenses, and we get to an operating profit. So in this case, the company makes $100 million of revenues. Operating profit is $20 million. The interest expense for this company was $5 million. There was a profit before tax. We subtract tax, and we get to a net income. So as we can see, the income statement takes, for a period of time, in this case a year, the year ending December 31st, 2010, the revenues for the company, subtracting all of the expenses, and in this case from those most linked to the products and services provided to those that are less linked to the products and services provided, but subtracting nonetheless all of them in the structure of the income statement to arrive at a net income or profit for the company. One of the things lastly I wanted to illustrate is if we were to make some assumptions about a future year, for example, we could say that in 2011 we would be curious what the company might make, and we could make some assumptions. Well, we could say that we might expect that the company might have revenues that are 20% higher. So the company might make revenues of $120 million. Now, because the cost of goods sold are directly proportional typically to the number of products sold and to the revenues, therefore, the cost of goods sold in 2010 was 60% of the revenues. So we could make the same assumption in 2011, and we could say for each $100 of product sold, we're going to have $60 of costs, which would mean that for $120 million of revenues, we'd have $70 million of costs, and we could again arrive at a gross profit. If we were to make the assumption that with 20% higher revenues, the other operating expenses, i.e. the selling, the administrative expenses, the depreciation, wouldn't change that much, because the company can make these sales without any changes to its other operations, i.e. it had spare capacity, it didn't have to increase its sales force, it didn't have to hire new accountants or new staff to make these sales, and we can assume that these sale numbers stay the same, and we could again calculate an operating profit. So in this case, the operating profit is obviously higher, we have higher revenues, and the costs are slightly lower. If we assume that the interest expense doesn't change, then we can see what the profit before tax is, and the income tax expense again is a proportion. In this case, we've assumed a 33% income tax rate. If we assume the same thing in 2011, we can see that the earnings, basically, we can calculate the earnings on this stylized income statement. And the reason I've done this is just to illustrate one thing very quickly, which is that a company like this, which has some costs that are directly proportional to the revenues, like for example the cost of goods sold, and some costs that are not directly proportional to the revenues, like the other ones, as we've made the assumption in this case, that there's tremendous impact on the bottom line or the net income to a change in revenues. So for example, if the revenues in this case went up by 20%, the actual net income or profit went up by slightly more than 50%. So the profitability of the company went up by quite a bit more than the 20% that the revenues went up by. If we were to change the number slightly, we said that in 2011 we would assume that the company makes 20% less revenues. In other words, it had 80 of revenues, and we do the same thing, we can see that the net income or profit actually declines by slightly more than 50%. So this is what the income statement does, and financial analysts and investors, in trying to assess what the value of a company is and how it's going to operate in the future, create models like this and spreadsheets looking at the company today and historically, but also often looking forward to see how the company's profitability will develop. An income statement like this can also be used to look at this company and compare it to other companies. How do they compare in terms of gross profit? Does the company generate, for each dollar of revenues, does this company generate more profit or more gross profit or more operating profit than another company in the sector? Where might there be opportunities to reduce costs? Which items seem extraordinarily large versus competitors? Which items seem extraordinarily large versus the company's history? And this income statement, as one of the 3 financial statements, would be found in the annual report for a publicly listed company, accompanied by notes that explain each of these items. For example, if the company had operations that are now discontinued, or if there are extraordinary items, this would all be detailed in the notes to the financial statements and the notes to the income statement. And this is the illustrated income statement example.